Greetings to our partners and friends around the world as we enter the final quarter of 2025. After a tumultuous start to the year, we think we finally have a strong grasp of Trump 2.0 and the global reordering underway. Indeed, our base case for the year is unfolding as expected. Of course, that does not mean that new risks have not emerged. At the forefront of such worries is the topic of independence, more specifically as it applies to central bank independence, due to a very direct and public campaign by President Trump to nudge the U.S. Federal Reserve into an easing cycle. Now, many investors are worried about the fraying of the Fed's institutional independence and its ability to conduct economically centered monetary policy. In our view, though, investor concerns about the Fed's independence are overstated. For one, the Fed has never been fully insulated from politics. It is designed to be independent within government, but not apart from government. Policy stances evolve with economic conditions and institutional considerations. For example, Chair Powell's shift from dovish to forcefully hawkish after his 2022 reappointment. Just as other officials, including current ones, have argued for easing in one regime and restraint in another. Non-economic considerations periodically enter the discussion as well. The Fed suffers from plenty of mission creep, from DEI initiatives to climate change agendas, because the dual mandate operates in a real economy with real constituencies. Moreover, political pressure is not new. Presidents and legislatures have long tried to sway the Fed from the Johnson and Nixon eras to contemporary calls by senior officials for rate cuts. Yet the system's safeguards have consistently contained these pressures. Staggered terms, statutory goals set by Congress rather than the White House, a professional staff culture, transparency requirements, and market scrutiny together create durable checks. In practice, these guardrails have preserved a level of independence sufficient for the Fed to deliver on its mandate, and there is little evidence that this time is any different. The policy mix favored by the Trump administration of lower rates, a softer dollar, rising asset prices, and continued expansion has largely materialized. The greenback has begun an orderly retreat from very overvalued levels, but still has a ways to go. Another 10 to 15% lower would bring it in line with our estimate of its fair value. Now, for non-US based investors, some diversification away from the dollar makes sense. As of only very recently, the S&P 500's year-to-date returns were only positive for a few currencies. For many, dollar weakness equated to negative returns in local currency terms. It is important, though, not to overreact, as we expect the dollar's remaining downside to be orderly and to evolve over a 5 to 10 year horizon. In the near term, investors should separate noise from signal, just as we've been arguing since Liberation Day. The US economy is not in recession, corporate earnings are advancing, and the Fed is preemptively easing for fundamentally sound reasons because the labor market is cooling and real policy rates are restrictive. In this configuration, risk assets typically fare well. Historically, over the past 4 decades, the S&P 500 has delivered a 15% median 12-month return when the Fed has resumed cutting rates while growth remained intact. The macroeconomic outlook. U.S. growth is slowing, but not stalling, and the policy mix is finally pivoting to meet it. Incoming U.S. labor data show a clear cooling, bolstering the case for preemptive Fed easing. Our base case is 2 more 25 basis point cuts through year-end, followed by measured reductions into next year, bringing the Fed funds rate to around 3%, as labor momentum has slipped below break-even job growth, while inflation pressures look more like a level shock from tariffs than a renewed trend, keeping the structural disinflation narrative intact. As personal balance sheets deplete their cash savings, steady consumption hinges on mortgage rates drifting lower. U.S. households are historically underlevered. They have amassed a substantial housing wealth, and the need lower financing costs to tap it. The Trump administration's focus on housing transmission and the market's path towards 4% 10-year yields should gradually reopen that channel. In addition, we continue to observe U.S. potential growth rising modestly. Productivity has improved post-pandemic, and early AI deployment is adding measurable contributions to GDP. That productivity impulse also helps offset tariff pass-throughs to prices, reinforcing the case for measured cuts rather than emergency easing. In our view, global spillovers remain manageable as Europe should firm as the trade drag fades and fiscal support appears in the data, while emerging market growth is steady, with China's exports rerouting despite higher U.S. tariffs. Our in-house Insigneo Forefront U.S. Recessionary Indicator indicates only an 18% chance of a U.S. recession over the next 6 months, consistent with a soft patch or re-acceleration sequence rather than contraction. In short, easing labor demand, contained inflation trends, improving productivity, and a policy stance shifting toward neutral real rates argue for below-trend but positive growth. Market forecasts. With recession odds contained and the Fed easing from restrictive levels, the near-term backdrop favors risk assets. Our base case remains unchanged from last quarter, as we expect that the S&P 500 will end the year toward the upper end of our target range of 6,500 to 7,000, and the U.S. 10-year Treasury remains anchored around 4% as term premium stabilizes and growth prospects improve. Historically, and as we mentioned before, across the last 4 non-recession cutting cycles, the S&P 500's median 12-month return was approximately 15%, with earnings doing more of the heavy lifting as multiples stabilize. Now, positioning remains only moderately risk-on, and cash levels among investors remain elevated, leaving tactical room for upside if the macro path tracks our base case. We favor quality cyclicals and cash flow producing growth companies with selective exposure to AI beneficiaries as the CapEx wave persists. At the same time, defense spending is rising globally. Maintaining a strategic allocation to defense/aerospace provides both cyclical participation and a geopolitical hedge. For rates, we expect a steeper curve over the medium term as policy converges towards neutral and growth normalizes. Within fixed income, we prefer high-quality carry and selective investment grade or BB credit, where easing reduces refinancing risk without inviting late-cycle spread beta. We also retain a constructive medium-term stance on emerging markets, supported by a softer dollar and easier Fed, as well as on gold as a portfolio hedge amid policy transition and ongoing currency debasement. And the yen remains a great hedge, as we expect that the Bank of Japan will be raising rates this year and probably next year as well. On a geographic basis, U.S. equities remain expensive on most metrics, no doubt about that. But while AI leadership argues for a U.S. core overweight, regional diversification is warranted as Europe benefits from German stimulus and parts of emerging markets like Mexico and Asia Tech benefit from supply chain shifts and easier financial conditions. Lastly, we wanted to expand on our long-standing, multi-year, structurally bullish stance on gold. Since 2019, gold is up 144%, actually outperforming the S&P 500 over that time period where it was only up 121%. Of course, now the common narrative is that the Trump administration has scared investors into becoming gold bugs. But a more nuanced view, however, shows that gold's multi-year bull market is not tied to Trump at all. It predates him, and it should outlast him. Years of financial repression from central banks, rising debt loads in the developed world, and politically constrained central banks have eroded confidence in fiat currency regimes. This is not only a U.S. problem, it is also a European and Japanese one as well. In fact, it looks less like a commodity story for gold and more like a central bank balance sheet story, with the primary driver being a structural multi-year divestment from the traditional reserve fiat currencies. Though this trend accelerated after the freezing of the Russian central bank's reserves, after the invasion of Ukraine, its roots go back further, anchored in prolonged and unwarranted quantitative easing and fiscal regress. This seizure, though politically expedient at the time, has reframed jurisdictional and seizure risks for large holders, particularly emerging market central banks that might eventually be caught in the crosshairs of the West's punitive reprisals. Post-2022, gold diverged higher while the real value of U.S. Treasuries fell. Foreign U.S. Treasury ownership slid from 40% in 2019 to 29% last year before Trump was in office, as central bank gold buying jumped from around 20 tons a month pre-2022 to 80 tons a month thereafter. Given its recent performance, many investors may be wondering if it is time to take profits on this trade. In our view, the answer is that we think this story may be just getting started. Today, the U.S. holds roughly 80% of its paltry reserves of around $1.2 trillion in gold. But the global average is 22%, and close allies of the United States like China and India hold 7% and 13% respectively. Now, of course, they are not close allies of the United States, and that is the point. Gold benefits as the least imperfect alternative currency because no one controls the global gold supply, unlike the Fed that controls the supply of dollars, the ECB with euros, the Bank of Japan with yens, etc., etc. Indeed, we see sustained central bank buying, broader private adoption, and a shrinking foreign bid for developed market sovereign paper as the core pillars underpinning the bull market. Currently, gold now ranks as the second most commonly held reserve asset in the world by central banks at 20%, if you exclude US reserves, which means that it has now overtaken the euro at 16%, and it only trails the US dollar at 46%. However, if current trends persist for a few more years, then gold may overtake the dollar as the primary reserve asset by early next decade. Neither the euro nor the renminbi is a threat to the dollar's status. Gold, though, it is plausible. If so, then a purely mechanical scenario in which central banks elevate gold's reserve share to match the dollar implies a spot price more than double current spot prices. In sum, we reiterate our bullish view on gold, and our year-end price target for this year remains $3,800. Though central bank buying has cooled from its recent peaks, it remains structurally elevated. Lower real rates, sticky debasement hedging, and investor-led inflows keep risks skewed higher into next year as well. The Fed's and other central banks' unlimited quantitative easing policies buoyed financial assets but eroded fiscal discipline. Political resistance to fiscal austerity should keep deficits wide. Ironically, the current impulse against central bank independence may be the consequence of the irresponsible policies they sowed decades ago. Over the long run, we think gold will be materially higher by the end of this decade. Of course, the key risk to our view is that austerity returns as a political force, causing fiscal policy normalization that restores fiat credibility. However, as long as the official sector keeps diversifying away from fiat money and developed market sovereign bonds, the path of least resistance for gold remains higher. We end today's presentation with a graphic that displays our recommended asset allocation for the final quarter of the year for an investor with a moderate risk profile. Thank you very much.